Oh, hi. Sorry, didn't see you there. I was just scoping out some new recipes in the Coles magazine. Very exciting stuff, but not as exciting as the drivers of globalization, which is what we're going to talk about in this video. So let's get it. When we're talking about the drivers of globalization, so we're looking here, that what we're thinking about is this. What are the factors that increase links between economies? So in your notes under that heading, drivers of globalization, make sure you're clear that these are the factors that increase links between economies. And let's go a step further. If we increase links between economies, we are increasing globalization, because remember, globalization is all about integration and links between economies. If we're thinking about this topic, there are 5 specific drivers that we're going to look at: trade in goods and services, financial flows, investment in T&Cs, technology, transport and communication, and the international division of migration and labor. For each of these ones, our focus is on how does each of these factors or drivers contribute to globalization? Okay, our first driver of globalization is trade in goods and services. So here's a few important things to know. Firstly, know that economies do not produce all the goods they need. In fact, economies have to engage in trade to secure the additional goods and services they require. Trade involves additional links, right? Relationships, agreements between different economies or between many economies. So the process of trade, so the process of moving goods and services between countries, the process of agreeing on trade terms between 2 countries or many countries, these things increase the links between economies and increase globalization. Some particular things to think about is you can think about consumer goods. China's production of so much of consumer goods has increased links between China and the rest of the world. And also that Australia's really strong performance in education has attracted many students from around the world and increased links that way as well. Our second driver of globalization is financial flows. And the easiest way to understand it is that financial flows involve the movement of money around the world. So money moving around the world. Now, finance is the most globalized feature of the world economy. And this is because financial flows are immediate. They happen instantaneously. That if I buy shares in America, that transaction happens almost immediately. So those are such strong links between an Australian investor and the US share market. Those movements of money happen so quickly. Another reason that financial flows help with globalization is that global financial flows allow nations to secure funding that is not available in the domestic economy. So countries will build links with other countries to be able to get that flow of money. And that money moving around, that's increasing those links, that's boosting globalization. When we're thinking about financial flows, that global financial flows have increased significantly in recent decades, that we're seeing more money than ever flowing around the world. And 2 particular reasons for that are technology. That technology increases the ease and speed of moving money around. So that's going to increase the links between different economies, but also that financial flows have increased because of the actions of speculators. Speculators are traders who make short-term gains or aim to make short-term gains from financial flows, from money moving around. They are benefiting from increasing links, and they in themselves are increasing links, moving money around different locations in order to get more rewards, to make more return. So financial flows, that's the movement of money. It's instantaneous. It creates really strong links and boosts globalization. Our third driver of globalization, our third factor that increases the links between economies is investment and transnational corporation. So the first thing we should do is just clarify that the financial flows we just looked at are not long-term. They're just short-term speculative shifts of money. Those investors are just trying to make a quick profit through that movement of money. Investment flows are the longer term movement of money to do things like buy or establish businesses. When we're talking about investment flows, one of the major types of investment flows is called foreign direct investment. So foreign direct investment is investment, for the purpose of starting a new business or buying a significant proportion of shares in an existing business. If an investor buys greater than 10% of the shares on offer, that's considered foreign direct investment. Another element of FDI is that investors are there for the long term. They want to take a stake in management, ownership, decision-making, all of those things as well. So FDI has significantly increased links between economies because you've got investors from one country that are coming in to buy controlling stakes or set up new businesses in others. So investors from one country are making moves to other countries and increasing those links. So those investors are setting up operations in new countries or increasing their involvement in existing businesses, that they're increasing those links between their home country and these new ones. If we think about the biggest investors that do this kind of task, what we're talking about are transnational corporations. So your things like Nike, Apple, McDonald's, that they play such an important part in these investment flows. Not financial flows, investment flows. And what I want you to do is just think about what happens when a TNC from one country, say an American TNC, sets up operations in another country, like, I don't know, Indonesia or anywhere else, that they bring money, people, infrastructure, knowledge. Think about all those links that now happen between America and Indonesia or wherever they set up. So people, infrastructure, technology, ideas, all increasing those links between economies. Okay, and then we come to driver 4, which is technology, transport, and communication. So let's think about it. If we've got, say, new technology to move freight, and freight being sort of goods. If you've got new technology to move freight, that you've got goods can move faster or more efficiently between economies. So more links between those economies. If I've got telecommunications, including the internet, think about how important that is. Think about how important telecommunications are, say like email, Skype, transferring files and resources in allowing people to do business and communicate across different locations. So boosting those links. Finance and investment technology. Basically here we're looking at the speed and ease of moving funds, so it's easier to invest and to form those links. And the final thing is the transportation and physical links. So we can more easily move physically, not virtually, actually physically move between different economies. So technology, transport, and communications made it easier to link to other economies and therefore boosted that process of globalization. Our final driver of globalization is all about the international division of labor. And what this means is that production processes are allocated to different workers in different countries around the world. If you look at a multinational like Nike, so the manufacturing of the shoes might take place in China or Vietnam and use workers in those countries, while those in America might handle the design and marketing, and those employees there would be focused on those tasks. Perhaps the best example of this is if you have an Apple product. If you just turn it around, have a look on the back and see if you can find this slogan. That Apple products promote themselves as being designed in California, but are physically made in China. So with globalization, we can have workers doing one task in one country and another set of workers in another country doing another task, and they're all linked together. Some things to think about here, though, is that which parts of the labor market might shift countries, might move locations. What we see is that at the top end of the labor market, so the highly skilled workers, that what they will do is they will leave their home countries to go and seek opportunities, better opportunities, higher paying. And what tends to happen is we see what's called a brain drain. That these skilled workers from low-income economies try to find opportunities in richer economies. So you get this brain drain of the best and brightest leaving their home country to a richer country, perhaps a more developed country, to get higher wages. The other thing we see is that at the bottom end of the labor market, so the low skilled workers, will they also seek out opportunities in richer economies because they could get higher wages for doing the same low skilled tasks that they do in their home economy. So the global division of labor, the fact that workers do different tasks in different locations, well, that increases the links between economy, boosts that process of globalization. Okay, so in this video, we've looked at the drivers of globalization. We've looked at all of the factors that bring economies and countries closer together by increasing the links between them. So for each driver, you should really be clear about how does this driver or factor increase the links between economies and increase that process of globalization. That's all I got for you. I'll see you in the next video.